Hi, dear all, this is Noor ACCA. This video is about the assertion and their audit. So, let's start the video. The audit of assertions. At this stage, I am assuming that you are aware of interim and final audit. I am just giving you an overview of interim and final audit as a basis of audit of assertions. So, interim audit. What auditor do during interim audit? During interim audit, internal control system is documented and evaluated, and the auditor do a mix of test of control and substantive procedures, but both will tend to focus on transactions that have occurred so far in the period. And here the transactions are sales, purchases and wages paid during the period. Now moving on to final audit. During final audit, the auditor will focus on the financial statements and the assertions about assets, liabilities and equity interest. In this video, I am going to discuss about the assertions in detail, so keep watching this video till end to bin the clutter about classes of transactions and account balances and their assertions. Okay, at this stage, auditor will design substantive procedures to ensure that assurance has been gained over relevant assertions. And now, assertions about classes of transactions and events and related disclosures for the period under audit. As I told you before, the transactions include sales, purchases and wages paid during the period. And here we do some procedures on classes of transactions during final audit to assure that all transactions are giving true and fair view. Occurrence. The transactions and events that have been recorded or disclosed have occurred, and such transactions and events pertain to the entity. At this stage, auditor will put some procedures to confirm that the transactions recorded is actually related to current period, such as the sales of its expenditures are actually related to current period or the period from which it related. As it is completeness means all transactions and events that should have been recorded, and all related disclosures that should have been included in the financial statements have been included. Now moving on to accuracy. Accuracy means amounts and other data relating to recorded transactions and events have been recorded appropriately, and related disclosures have been appropriately measured and described. Furthermore, the classes of transactions assertions include cut-off. Cut-off means transactions and events have been recorded in the correct accounting period. And at number 5, classification. Classification means transactions and events have been recorded in the proper accounts. And finally, we have presentation. Presentation means transactions and events are appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable in the context of the requirements of the applicable financial reporting framework. Some of us used that assertions about classes of transactions are the assertions of statement of profit and loss, and the assertions about account balances are the assertions of statement of financial position. It's good to cram about, but I think you should focus on the basic concepts from day one. So moving on, assertions about account balances and related disclosures at the period end. It includes assets, liabilities and equity interest. At this stage, the auditor will ensure that the recorded assets, liabilities and equity interest are actually existence, assets, liabilities and equity interest exist. Rights and obligations means the entity holds or controls the rights to assets, and liabilities are the obligations of the entity. Completeness means all assets, liabilities and equity interest that should have been recorded have been recorded, and all related disclosures that should have been included in the financial statements have been included. Furthermore, we have accuracy, valuation and allocation. It means that Assets, liabilities, and equity interest have been included in the financial statements at appropriate amounts, and any resulting valuation or allocation adjustments have been appropriately recorded, and related disclosures have been appropriately measured and described. And now we have classification. In this, auditor will ensure that assets, liabilities, and equity interest have been recorded in the proper accounts. And now finally we have presentation. Assets, liabilities, and equity interest are appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable in the context of the requirements of the applicable financial reporting framework. As an auditor, you would ensure all the assertions to give an appropriate assurance about the financial statements, and that's all for today. If you have any query, then you can contact me at given email ID, or you can comment here. Don't forget to subscribe my channel for more useful videos. Good luck.